All right.
Hello, everyone, and welcome to the presentation Mastering RSU Strategy. This is a very niche topic with a heavy intersection with financial planning and investment planning, tax advising, and estate planning. However, it is very important for financial counselors and coaches to understand the fundamentals so you can guide the discussion and direct your clients to dedicated professionals if you happen to have a client who has restricted stock units as part of their compensation. So why I'm talking about this topic? Um, I've worked in the tech industry myself, so I have a first-hand experience how confusing the restricted stock unit compensation is. I've seen a lot of people who made suboptimal investment decisions, who got hit by huge surprise tax bill during the tax season. So I believe it is very important to increase knowledge about this topic and also educate financial coaches so you can educate your clients if you have clients who has restricted stock units as part of their compensation. Um, okay. So as I mentioned, this topic is heavily intertwined with investment conversation, tax conversation, and legal questions. It's important to remember that it's not tax, investment, or legal advice. And when you talk to your clients, it's also important to direct them and encourage them to consult with qualified professionals in their respective areas. But again, as I mentioned, it is important for us as financial counselors to be able to guide the discussion. We have a lot of grounds to cover today in the next 25 minutes. We will not be able to go into every single detail, but I hope and my goal is to give you a framework on how to talk about those questions with your clients. And now, before we get uh, into the details, I would love to know how much experience you have with RSUs. If you see this Slido instruction on your screens, please pull up your phones and submit a survey. What kind of experience with RSUs you have? Okay, I see a few responses. Okay, I see someone received RSU compensation, never received, but never worked with the clients, never heard about anything. Okay, great. Um, so then I hope you will learn a lot of useful things today. And we will start with the most important terminology to be able to have this conversation and discuss RSUs. We need to establish the key foundations. So, what is RSU? RSU is restricted stock unit, and it's a promise of a company to give employee shares of that company. It's important to understand that the RSUs do not belong to the employee yet. It's a promise. It's a promise that at some point in the future, an employee will get share of a company in the form of stock of this company. The date when these restricted stock units are given to the employee is a grant date. So basically, again, it's a date when the company promises an employee future shares. So the grant date is the first important date to understand. It's the date when the stock is given to the employee. During the grant date, no tax event happened and no change of ownership happens yet. It's only a promise. The third important term is vesting. Vesting is a timeline when those promised stock units actually become shares that employee owns. So this is a moment when the ownership transfers from the company to the employee. And this is one of the key dates to know because during the vesting, the income tax is being paid. So this is one of the key milestones. So the vest date is a date when the stock is moving from the company to the employee. And again, as I mentioned, it's becoming a taxable event. The next important term to know is fair market value. Because we will be talking about several different milestones in the life of the restricted stock unit. And the value of the investment that employee owns is decided based on the fair market value. Basically, it's how much the stock is actually worth on the market. The next important term is withholding. Because vested shares is a taxable event, the companies usually withhold part of those units to pay for the taxes. And we will talk a bit about taxes a bit later. It's important to understand who's the broker or brokerage account. Usually all these transactions are operated by one of the financial institutions. You have many of them like Morgan Stanley or Charles Schwab, or E-Trade, Fidelity, Vanguard. Any of those companies could hold the stocks for the employees, depending on which financial institution the company chooses. And the last term to know is the dividend. We are not going to talk about dividends a lot in this presentation, but it's just important to remember that some restricted stock units can also have dividends which paid on those units. Okay, now once we have the terminology covered, we can talk about the life cycle of the restricted stock units. There are 3 critical dates which are important for an employee and for a counselor to guide the discussion with employees. First date is the grant date. That's where the stock was promised to the employee. No tax event happens at that time. It's just a promise. The second important date is the vesting date. That's the date when the stock became the asset owned by the employee. And it is critically important to remember that at that moment, this stock is taxed as ordinary income. And this is one of the major gaps in knowledge and understanding when people try to make decisions about selling stock or keeping stock or somehow optimize for taxes. Nothing of this matters because stock is taxed upon vesting, regardless of what people decide to do with the stock. And the third important date is the sale date. That's where people decide to sell their stock, if they ever decide to sell it. And at that moment, it's taxed as capital gain tax. So those are the 3 critical milestones to remember. Now we can deep dive into the first one, the grant date. Again, grant is a promise by the company to give stock in the future. What is important to know here? That there are 2 different types of grants, new hire grant and refresh grant. New hire grant is the grant when employees usually get when they just join the company. It's part of the job offer, and usually it's the biggest grant that the employees will get. It provides the motivation and incentive for an employee to actually join the company. And usually the grant is vested over 4 years. So the job offer may look like there's a base salary, let's say $100,000, there is a bonus, 15%, and there is a restricted stock unit of $200,000, which will vest over the next 4 years. So that would be part of the initial job offer for a person. A refresh grant is something that is given to an employee on an ongoing basis. Usually starting year 2 or 3, employees get yearly refresh. Most often, those refreshes are smaller than the initial grant, but they're also vested over the next 4 years after every refresh. It is important to understand the schedule of all of these new grants and refresh grants to help clients to anticipate their yearly income. The vesting over the 4 years, 4 years period also can happen in 4 different ways. The most, not one of the ways which many companies use is called 1-year cliff. It means that during the first year, the employee doesn't get any stock at all. After 12 months, employee gets 25% of this initial grant at once, and the remaining 75% vests over the next 3 years. Some examples of companies who use this vesting schedule is Instacart, Snowflake, Uber, and most startups use this scheme. The reason they're using it is that guarantees, or at least increases the chances that the new employee will stay with the company at least for a year. If the employment is terminated within the first 12 months for any reason, then the employee doesn't get anything because the first vesting date hasn't come up yet. The second popular vesting schedule is proportional, is when every year employee gets 25% of their full-year grant, usually on monthly or quarterly basis, in equal portions. Examples of companies which use proportional vestings are Meta, Microsoft, Salesforce, Adobe, and many other companies use even split. The third popular time is backloaded vesting, when the majority of the initial grant happens in the third and fourth year of the initial 4-year period. And companies who are famous for their backloaded schedules are Amazon and Apple. And what companies are trying to achieve with this is to increase employee retention, because people have more motivation to stay longer with the company so they can get more of their stock in the third and fourth years of their employment. And the fourth type of the vesting schedule is front-loaded, which is exactly opposite to the backloaded, when the majority of stock compensation is given in the first and second year. Examples of those companies are Google, NVIDIA, and Databricks. And with this compensation, companies are trying to achieve opposite effect. They want their job offer to look more attractive for prospective employees, because in the first 2 years, their total compensation will be way higher. So in the industries where there is a high competition for the talent, companies tend to use front-loaded vesting schedule. Why it is important, again, to understand for us as financial counselors and coaches and for the employees, it directly impacts the cash flow and income planning for years to come. The initial grant and subsequent refreshes, they stack on top of each other. And if you see on the chart on the left, the dark green has 4 equal shares. It was the initial grant. The second year, there was no refresh, so stock compensation is the same. But year 3, now we have new refresh grant on top of it. It's light green. Then year 4, we have new refresh on top of it. So we have 3 grants already stacked on top of each other in year 4. So that makes year 4 the highest income year for the majority of the tech employees, especially if the vesting schedule was even or backloaded. Subsequently, what happens in year 5, the income may drop significantly if refresh grants didn't catch up with that increase. A lot of people get surprised that year 1, 2, 3, 4, their income grows year over year significantly, and then year 5, they suddenly have huge decline in their income. So there are 2 important things to plan here. For years where income grows, it's important to anticipate taxes and also plan for this income and decide what to do with this extra income in all of those years. And for year 5, it's important to get ready for this income decrease if it happens. So it's important to calculate in advance how the projection would look like. That was all the important milestones for the grant date and important information. Now we can move to the second important date, which is the vesting date. Vesting date is when, again, stock actually becomes an ownership of an employee. And this is the date when restricted stock units become ordinary income and they are taxed. I will not get tired of repeating it. The restricted stock units are taxed as income upon vesting. This is one of the huge misconceptions in the industry and misunderstanding when people get surprised with their tax bill. When stock vests, it becomes part of W-2, and it is reflected there as income. However, there is a tax gap or trap which happens, and many people are not aware of it. The restricted stock units are classified by IRS as supplemental wages, which means that they are taxed at 22% flat rate for federal withholdings, which is way less than the majority of tech employees actually end up with their marginal tax rates. If these taxes are not calculated correctly, a lot of people get surprise tax bills. For example, if the taxes is not calculated and not adjusted, a client who gets $100,000 vested in RSU per year, they may face more than $10,000 of surprise tax bill. So calculating the expected taxes is extremely important. The federal tax rate changes from 22% to 37% the moment that RSUs reach 1 million vested per year. But truth to be said, the majority of people are not reaching $1 million threshold. The majority of people are staying under 1 million people compensation. So they pay 22% automatic tax, which is severely below their actual tax rate. Every state also has their own rules about supplemental wages taxes. That needs to be researched separately for every state. But for example, in California, they're also taxed at a flat rate at 10.23%, which may or may not be the actual tax rate of a person. And also it's very different for every state. As discussed before, for the tax planning, it's good to guide your client to a CPA or tax advisor to make the right decision for them. But generally speaking, there are a few different strategies which could be explored. The first one is the easiest one, is to adjust W-4 for extra withholding. That will make sure that there are regular deductions from the paycheck, which accounts for these underpaid federal taxes. However, disadvantage of this method is that you still need to calculate what is that extra withholding, which could be hard without using specialized help. And also, if this stock price fluctuates a lot, this adjustment may need to be constantly changed throughout the year. The second strategy that could be explored is make quarterly payments. Basically, every quarter, calculate what is this amount of under-withheld tax in paid, which also requires, again, a lot of work from the client and a lot of calculation. And the last strategy, which could be used in combination with first and second, is always have cash reserves in case taxes were under-withheld. So there are no surprises during tax season, and the client actually has available funds to pay tax bill for not under-withheld federal tax or restricted stock units. Okay, so moving to the very last important date is a sale date. This is the date when a person decides to sell their stock. There are 5 different approaches which people can take to sell their stock. People can sell them immediately after vesting. People can decide to maintain certain percentage of their net worth in this restricted stock unit and sell the rest. People can decide to sell part and keep part, maintaining specific percent. For example, every vest the client gets, they keep half and sell half, regardless of what share of net worth it is. People may just keep it and do nothing, effectively passively holding all their investments. And the last one is just sell whenever something happens in the market, but do not really have any strategy. And now I have a question to the audience. Which one do you think is the most common? What people actually do most of all when they make a decision what to do with their restricted stock units? Just type in the chat. What do you think is the most common behavior?
That's my thought, is immediate.
Okay. I think you're just, you know what is better. Um, any other ideas? What do you think people do
I see
more
passive
often than not?
holding, immediate, liquidate, passive, passive.
Uh, yeah, yeah. Actually, surprisingly, but more often than not, people just passively holding. And this is an interesting psychological trap because when they already have something and then they need to dispose it, it feels like we're losing something. Like, why would we sell something that you already have, especially if the perceived value of the stock is very high and I already got it? People don't do anything. And as you work with clients, and you know, there are a lot of, again, inertia, psychological thinking. People don't know what to do with this money. So then why would I sell it? I better keep it. Or what if the stock goes up? I want to keep it. So there are a lot of reasons, a lot of explanations why people say that they want to keep it, or they just don't want to make a decision and they just let it be. However, if you think about more optimal strategy, uh, and again, we're now going into investment space now, and uh, every client should consult with their investment advisor what is actually better for their portfolio. But the main point here that the client should make active decision and not passive holding. And if the decision then is still to hold, it is a valid strategy which may work for the specific client, but it should be an active decision and not just passive allowance for the stock to stay. And the conversation, which is important at this moment to have with the client, is the concentration risk. If you think about the person who works in a company, they already have their salary and bonus and all their future career dependent on that company. Now they also have unvested equity, which is grants, which is not vested yet, also dependent on that company. And the stock prices fluctuating will define their future income. And if people also keep the vested stock in the same company stock, now their net worth is also exposed and dependent on that specific company's success. It is already a triple risk exposure. And any financial professional will say that you should diversify your portfolio and your life in general. And in this scenario, your current compensation, your future compensation, and your net worth is now hugely intertwined with your current employer. And on top of this, in certain areas like Bay Area, where the tech sector is hugely concentrated, even the real estate market is dependent on those companies' success. Oftentimes, people buy primary property or rental property to diversify their portfolio. But in those areas, it's not just Bay Area, it's also Seattle and some other places where companies are concentrated in a specific sector. If something happens with the large company or sector at large, even real estate market is at risk. So now you can have a client whose current, future compensation, their net worth, and even their primary home price is dependent on one company's success. It all depends on the client risk tolerance and how much risk exposure they're actually willing to take. But it is good to have this conversation so they understand how much they're exposing to a very specific company. To help a client to make a decision whether to keep or sell their stock, it's good to reframe the question from you have a stock and maybe you wanted to sell and ask a different question. If you got $200,000 cash bonus today, would you use all this money, 100% of it, to buy your company stock? For the majority of clients, the answer would be no.
That's a good question.
They would have, yeah, absolutely. They would have different ideas what they would do with this money. It could be starting from I will spend them on things which matter to me, like vacation, or I would invest them in somewhere else, or maybe I would buy a primary or secondary property. There are so many things which we actually can make with this money, but by passively holding the stock, basically clients do not have this opportunity to make an intentional decision of how they want to spend their money. So we've discussed that the restricted stock units are taxed as income. So it's good to have this mindset for clients. They should think about it as income and not as an investment. And the investment decision should be made separately and intentionally. And again, it could be the decision that they want to invest all their money in their one company stock, but for the majority of people, it's not the most optimal strategic decision. It's good for a client to have their own net worth and investment strategy. Probably they would consult with the financial advisor, and then they need to allocate this money in accordance with this strategy. One note to make here that, again, before selling, it's always good to have a plan. And I would be a devil advocate here that if there is no plan, then it's better to keep. But to keep the stock. But the moment they have a plan, they understand the tax implication, and they know what they're going to do with this money, then they should proceed and actually use this money in accordance with their strategy. We have a couple of minutes left, and we're almost at the end. The very last important consideration is estate planning. For clients who have a lot of RSUs, probably, again, whether vested or unvested, they would comprise a large portion of all overall estate of a family. So it's important for a client, for employee of company who has RSUs as part of the compensation to plan for what happens with this stock if person dies. For vested shares, it's always good to have transfer on death. So you should encourage your client to work with the broker company who holds the shares to make sure that they have transfer on this on file. The second question, which a lot of people miss, is the company policy on what happens with unvested shares. Technically, those shares are not belonging to employee yet, so they're not asset. So you cannot have beneficiary designation on those shares because they don't belong to you. But some companies, for example, Google, they have a policy that upon death of an employee, all unvested shares immediately vest. So the family gets these shares. So it's important to remind a client to check company policy, what happens with unvested shares, and have specific rules set up in their brokerage account. So this invested shares goes to the right beneficiaries. To sum up the estate planning essentials, again, the first one, transfer and death designation, very important to have on file for every brokerage account. It is good to remember that when beneficiaries inherit an asset, it is inherited at step-up basis, so they will significantly save on capital gains tax if they decide to sell those stocks. It is crucially important to know company's policy, what happens with unvested stock, because again, it could be a huge benefit for a family if all the paperwork is done correctly and the company stock goes to the right beneficiary. And the last point, it's always good to remind our clients to work with legal professionals and consider creating a trust, especially if they have children. So all these restricted stock units actually managed well and get to their beneficiaries. Key takeaways from this presentation, we've covered a lot. So several things to remember. It's good to think about restricted stock units as income and not an investment. It is important to know the vesting schedule and understand the stacking effect of different grants to be able to plan the income and cash flow for future years. It is always crucial to have a plan before stock vests, what the client wants to do with the stock, either keep or sell, or some combination of this, something in the middle. It is important to watch out for tax surprises, specifically for federal income tax, which is flat 22%, which is way below than the average tech employee actually gets at their effective rate. It is important to remember about diversification and concentration risks when planning the RSU's strategy. And it is also important to set up beneficiaries to make sure that if anything happens with the employee of a company who has restricted stock unit, that these stocks go to the right beneficiaries in the easiest possible way. Thank you. Thank you for listening and learning about restricted stock units, and wishing you success with your customers and clients.
All right. Any questions for Elizaveta? Thank you very much. We'll get the code up here.
Yeah.
I did put it in the
Thank you.
chat too. That was a lot of information. When you sent me your outline, I'm like, this is a 2-hour class.
Yeah, there is a lot to process.
So code phrase is RSU 2026. There we go.